Imagine a company that started by making adult toys, like balancing scooters, and ended up controlling the neural network of urban micromobility. Welcome to Ninebot 2025. We're not just looking at a 50% revenue jump, we're witnessing a value leap. The moment a hardware company starts thinking like a Silicon Valley software giant, it's like watching a local scooter shop suddenly upgrade its brain to an AI supercomputer overnight. Ninebot's 2025 is a masterclass in profitable scaling. While most EV players are bleeding cash to buy users, Ninebot pulled off a 62% profit surge. That's not just growth, it's an efficiency flex. With a 26% ROE, they are essentially a money printing machine that happens to have two wheels. Think of them as the Lululemon of scooters: high margins, cult following, and zero interest in a price war. Revenue hit nearly $3 billion. To put that in perspective, that's enough to buy every single person in New York City a high-end electric scooter and still have change for coffee. But the real story is the slope. A 49.9% CAGR is the kind of trajectory usually reserved for viral SaaS startups, not companies that actually have to weld steel and ship batteries. It's a hardware business running on software speed. Let's talk about the golden triangle: gross margin, net margin, and ROE. Ninebot hit 29.6% gross margin. In the world of hardware, that's moving from the struggle bus to the first-class cabin. They aren't just selling more units, they're extracting more value from every atom they ship. It's the difference between selling bulk flour and selling artisanal sourdough. The ingredients are the same, but the smart tax is much higher. 4 million electric two-wheelers sold. That's a small army on wheels. But look at the service robots. Though the volume is smaller, the margin is a massive 52%. While the scooters provide the bread and butter volume, the robots are the truffle butter profits. Ninebot is effectively using its scooter cash flow to build a robotics empire, playing a game of subsidized innovation. Navimow is the iPhone moment for lawnmowers. By ditching the primitive perimeter wires for EFLS 2.0 LiDAR fusion, Ninebot didn't just improve the product, they deleted the competition's relevance. Dominating the European Black Friday charts isn't luck. It's what happens when you bring a laser-guided robot to a manual blade fight. This isn't a mower, it's a computer that happens to cut grass. Now, for the cold shower moment. Inventory is up 72%, that's $441 million sitting in warehouses. When inventory grows significantly faster than sales, the McKinsey alarm bells start ringing. Is this strategic stockpiling or channel stuffing? If 2026 demand cools down, this mountain of plastic and lithium becomes a liability. It's like holding a massive balloon in a room full of needles. One market pop and the impairment hit will be painful. Branding is expensive. Selling expenses spiked 71%, fueled by massive celebrity endorsements. Ninebot is spending $260 million to make sure every Gen Z kid in China and every techie in Europe knows their name. But here's the reality check. When marketing spend outpaces revenue growth, you're not just building a brand, you're paying a tax on attention. 2026 will be the year they have to prove these fans have actual brand loyalty, not just discount fever. Ninebot is playing a dual-engine game. China is the high-speed volume engine, growing at 58%. Overseas is the high-margin shield, with 36% margins. They are essentially using the massive scale of the Chinese market to R&D products that they then sell to the rest of the world at premium prices. It's a global arbitrage strategy that makes them incredibly resilient to local economic dips. They've moved from Amazon only to omni-channel domination. Being on the shelves of Costco, Walmart, and MediaMarkt isn't just about sales. It's about social proof. If you can survive the brutal vetting process of a Tier 1 global retailer, you've officially graduated from a startup to a staple. Ninebot is now a permanent resident of the global retail landscape. $174 million in R&D and 4,000 patents. That's a very expensive no trespassing sign for competitors. Ninebot isn't just building vehicles. They are writing the standards for the entire industry. When you define the rules of the game, you're not a player anymore. You're the house. And as we know, the house always wins. The endgame isn't the scooter, it's the nimble OS. Every mile ridden and every blade of grass cut is data. By monetizing the cloud and OTA updates, Ninebot is trying to pull a Tesla move, selling you the hardware once, but selling you the intelligence forever. They are moving from a one-off transaction to a lifetime subscription. Geopolitics is the final boss. With $659 million in USD exposure, Ninebot is basically a hedge fund that happens to sell scooters. They are managing tariffs and VIE structures like professional diplomats. In 2026, their ability to localize and hedge will be just as important as their ability to innovate. It's a high-stakes game of global chess. The era of growth at all costs is dead. Long live Value Leap. In 2026, Ninebot's mission is to turn that massive inventory into cash and that massive marketing reach into profit. They've built the rocket. Now they have to prove they can stay in orbit without burning through all their fuel. Our HDIN verdict? Ninebot is an alpha play in smart mobility, but watch that inventory like a hawk. They've successfully pivoted to high-margin robotics, which is their true golden goose. If they can maintain fiscal discipline, they aren't just a leader, they are the blueprint. Recommendation: overweight, but keep your stop-loss tight. Thanks for diving deep with HDIN Research. If you want the full-page PDF of this analysis, with the raw data and the McKinsey-style breakdown, drop us an email at sales@hdinresearch.com or click the link in the description. Don't forget to comment your thoughts on Ninebot's inventory surge and follow at HDIN230 for more no-nonsense market intelligence. See you in the next deep dive.